common trading mistakes are rarely caused by lack of information. Most traders today have more charts, indicators, news, and educational content than any previous generation. And yet the failure rate remains stubbornly high. This paradox exists because trading mistakes are not technical errors. They are behavioral leaks. They happen not when traders do not know what to do, but when emotion, impatience, or ego overrides what they already know. Understanding these mistakes is less about learning something new and more about seeing yourself clearly under pressure. One of the most destructive mistakes is overtrading. It often masquerades as discipline and hard work. Traders feel productive when they are active, scanning, constantly entering, frequently adjusting positions repeatedly. In reality, overtrading is usually a response to discomfort with waiting. Markets do not offer opportunity evenly. There are periods when conditions are favorable and periods when the best decision is to do nothing. Traders who cannot tolerate inactivity manufacture trades, turning randomness into risk. Over time, transaction costs, poor entries, and emotional fatigue erode accounts quietly but relentlessly. Closely tied to overtrading is the mistake of trading without a clear edge. Many traders confuse familiarity with edge. Just because you recognize a pattern or feel comfortable with a setup does not mean it has positive expectancy. An edge is not how confident you feel. It is a repeatable situation where probability and payoff justify risk over many trades. Traders who skip this work end up relying on intuition built on too little data. When losses arrive, they have no framework to distinguish variance from failure, leading to constant strategy hopping. Another common error is poor risk management, especially inconsistent position sizing. Traders may use stop losses, but still risk wildly different amounts from trade to trade, based on confidence, recent wins, or emotional state. This inconsistency destroys mathematical expectancy. A solid strategy can be rendered unprofitable simply by uneven sizing. Professional traders think in terms of account risk first and trade ideas second. Amateurs reverse that order, letting excitement dictate exposure. Moving stops or removing them entirely is another classic mistake, and one of the most expensive. Once price moves against a trader, the urge to give it more room feels rational. In reality, this is loss aversion taking control. The stop was placed for a reason to define where the idea is wrong. Moving it converts a planned loss into an emotional negotiation. Over time, this habit creates a portfolio of small wins and occasional devastating losses. Trading does not punish being wrong. It punishes refusing to admit it. Revenge trading deserves special attention because it often follows a single emotional trigger. A loss feels unfair, mistimed, or personal. The trader immediately looks for another setup, not because it is good, but because they want emotional relief. This is one of the fastest ways to compound mistakes. Revenge trades are rarely planned, poorly sized, and executed without patience. Traders who survive long-term build rules that force pauses after losses, protecting themselves from their most reactive impulses. Another subtle but damaging mistake is ignoring context. Traders focus narrowly on patterns or indicators without considering broader market structure, trend, volatility regime, or upcoming events. A setup that works beautifully in a trending market may fail repeatedly in a choppy one. A breakout strategy applied during low volatility often disappoints. Context determines whether a signal is meaningful or noise. Traders who ignore context often blame the strategy rather than the environment. Confirmation bias also plays a powerful role. Once a trader forms a bias, they subconsciously filter information to support it. Bullish signals are emphasized, bearish ones dismissed. This leads to holding losing trades too long and exiting winning trades too early. The chart becomes a mirror for belief rather than a tool for assessment. Traders who improve learn to ask, "What would tell me I am wrong?" before entering, not after. Many traders also suffer from inconsistent review habits. They remember big wins and painful losses, but forget the hundreds of small decisions in between. Without structured review, mistakes repeat unnoticed. Journaling is often recommended, but rarely done well. The goal is not to record trades, but to record decisions, emotions, and rule adherence. Improvement comes from identifying behavioral patterns, not just technical ones. Another overlooked mistake is expecting linear progress. Traders assume that if they are learning, results should improve steadily. When drawdowns or plateaus occur, they conclude something is broken. In reality, trading skill develops unevenly. Periods of stagnation often precede breakthroughs. Expecting smooth growth creates frustration and premature abandonment of otherwise viable processes. Finally, one of the most dangerous mistakes is identity attachment. When trading becomes a measure of self-worth, objectivity collapses. Losses feel like personal failure. Wins feel like validation. This emotional entanglement amplifies every decision. Traders who last separate identity from outcome. They see trading as a probabilistic business, not a reflection of intelligence or character. This separation allows learning without defensiveness and discipline without shame. What unites all these mistakes is not ignorance, but humanity. They are expressions of normal psychological responses to uncertainty, risk, and feedback. The market does not exploit traders because it is malicious. It exploits them because it is neutral and they are emotional. Avoiding these mistakes does not require perfection. It requires structure strong enough to limit damage when emotion inevitably appears. And this is where the conversation must go deeper, because recognizing mistakes intellectually does not prevent making them in real time, and understanding how to build practical safeguards, routines, and rules that interrupt these behaviors before they cause harm is the real work, which is exactly where we need to go next, by examining how to replace common trading mistakes with systems that work even when discipline is weak, because discipline alone is unreliable under stress. The first safeguard is pre-commitment. Every trade should be planned completely before entry setup, entry stop, target position size, and exit conditions. Writing this down or encoding it into a checklist removes negotiation later. When rules exist before emotion appears, emotion has less room to interfere. The second safeguard is risk standardization. Decide on a fixed percentage of account risk per trade and never deviate. This single rule neutralizes overconfidence, revenge trading, and fear-based hesitation. When every trade risks the same amount, individual outcomes lose emotional significance. Trading becomes process-driven rather than outcome-driven. Many traders fail not because their strategy is bad, but because their risk varies wildly with mood. Another powerful safeguard is forced inactivity. Build rules that require you to stop trading after certain triggers, a daily loss limit, a sequence of losses, or signs of emotional agitation. Stepping away feels counterproductive in the moment, but it prevents small mistakes from cascading. Markets will still be there tomorrow. Capital and mental clarity may not be if you push too far. Context filters are essential. Before taking any trade, confirm that market conditions match your strategy's strengths. Trend strategies need trend. Range strategies need balance. Volatility-sensitive setups need appropriate volatility. This filter alone eliminates many losing trades. Traders who skip this step often blame execution, when the real problem was misapplied strategy. Structured review transforms mistakes into feedback. Set aside time weekly or monthly to review trades not by P&L, but by rule adherence. Ask simple questions. Did I follow my plan? Did I size correctly? Did I respect my stop? Patterns will emerge quickly. Improvement happens when behavior is adjusted systematically, not when emotions are vented informally. Simplification is another overlooked safeguard. Too many strategies, indicators, or markets increase decision fatigue. Fatigue erodes discipline. Fewer tools, deeply understood, produce better results than constant novelty. Professional traders trade less, not because they are lazy, but because they are selective. Finally, identity separation must be intentional. Treat trading as a business with costs, variability, and risk, not as a personal scoreboard. Losses are expenses, not insults. Wins are outcomes, not proof of worth. This mental shift reduces defensiveness and accelerates learning. Traders who make this shift earlier avoid years of unnecessary suffering. In the end, avoiding common trading mistakes is not about becoming more disciplined. It is about designing an environment where discipline is less necessary. Systems replace willpower. Rules replace emotion. Structure replaces hope. Traders who survive and grow are not those who never feel fear or greed, but those who built safeguards before those feelings appeared. If this helped you see your own trading challenges more clearly, consider subscribing to stay with these long-form conversations focused on building structure that protects traders from themselves, and leave a comment sharing which safeguard you think would help you most right now, because the most effective improvement often comes from fixing one leak at a time.